Canada's housing market is broken, but not in the same way everywhere. We talk about the Canadian market like it's one thing, but it's not. It's a patchwork of micro-economies, each shaped by population flows, jobs, land scarcity, local politics, and investor sentiment. So today we're counting down the 10 best cities to invest in for 2025. And yes, you might be surprised by where your city lands. We rank these places using an institutional-style scorecard: population growth, rental demand, and rent levels, vacancy trends, affordability versus income, long-term job stability, housing supply pipelines, investor-friendly policies, and the financing environment. Number 10, Winnipeg. Winnipeg lands at number 10 because it offers something rare in Canada: predictability. Population growth is modest and consistent, not explosive, which produces steady rental demand year after year. One-bedroom rents sit in the mid-$1,400 in 2025 snapshots, giving relatively strong rent-to-price ratios for duplex and triplex investors. Vacancy here is more balanced than coastal metros, so leasing is predictable and management headaches are lower. This is a yield market, not a speculation market. Neighborhoods such as Wolseley, St. Boniface, and the Exchange District deliver the best rent-to-price math, especially for low-rise multifamily buys. But the trade-off is appreciation. Winnipeg rarely sees dramatic price appreciation compared with provincial growth leaders. Number 9. Vancouver. Vancouver is a long-term equity fortress. One-bedroom rents push into the mid to high $2,400 in recent reports, reflecting international demand and supply constraints, geography, and scarce developable land keep upward pressure on prices. That scarcity is why Vancouver holds value over decades. However, provincial rent increase limits, set at 3% for 2025, restrict how quickly revenue on existing tenancies can grow, making short-term cash flow difficult for small investors. In practice, most investors orient toward equity, redevelopment, or luxury segments rather than monthly cash flow. Expect better yields on the urban fringe, Surrey or New Westminster, where transit projects create pockets of upside. Number 8, Toronto. Yes, Toronto at number 8 will shock some of you. The GTA still attracts the largest number of newcomers in absolute numbers, so rental demand is enormous. One-bedroom rents sit in the low to mid $2,400 on current listings, and the region's job diversity remains unmatched. But the math bites. Sky-high acquisition costs compress cap rates, and tribunal backlogs add real operational risk. Eviction and arrears disputes can take longer to resolve, increasing carrying costs. Recent provincial reforms bundled in Bill 60 aim to speed approvals and hearings, but they also create political friction and legal uncertainty that investors must price in. For most small investors, Toronto works only if you accept low initial yields in exchange for liquidity and long-term appreciation. Number 7. Ottawa. Ottawa is the defensive pick. Federal government jobs anchor demand, producing steady rents and low volatility. One-bedroom rents trend just under $2,000 in current market summaries, and vacancy tends to stay stable even when private sector metros wobble. That means fewer sudden downturns in rental income and lower arrears risk. Neighborhoods such as Centertown, Westboro, and Hintonburg combine steady tenant pools and decent appreciation. The downside is limited upside acceleration. You trade the potential for explosive gains for lower risk and reliable returns. Number 6, Hamilton. Hamilton is a textbook spillover market. Since the post-pandemic price gap widened in the GTA, Hamilton absorbed demand from people priced out of Toronto, lifting rents and home prices in commuter corridors. One-bedroom rents sit around the mid-$1,700, and logistics, healthcare, and manufacturing expansions have diversified the employment base investors, targeting neighborhoods like the North End or areas close to transit, and the future LRT can capture both yield and appreciation. The main downside is the policy shadow cast by Ontario. Provincial rent guidelines and tribunal delays still affect turnover strategies. Number 5. Edmonton. This is one of the country's best cash flow markets. One-bedroom rents are in the low $1,300, while entry prices sit well below coastal levels, producing attractive cap rate prospects for buy-and-hold investors. Alberta's landlord framework offers an important benefit. There's no province-wide percentage cap on rent increases. Landlords must provide 12 months between increases, but there is no annual ceiling, which supports revenue flexibility. That flexibility, combined with a stable services and construction economy, gives Edmonton strong monthly income potential. The Achilles heel is cyclical sensitivity to commodity prices. Downturns can cut hiring and slow migration. But the city's economy has diversified enough that shocks are less destabilizing than a decade ago. Number 4. Montreal. Montreal is underrated. Acquisition prices are lower than Toronto or Vancouver, and one-bedroom rents average around the mid-$1,700, producing better yield potential for many investors. Demand is fueled by a large student population, steady immigration, and an expanding tech scene. The rental tribunal framework is different. Rent adjustments and eviction processes route through the Tribunal Administratif du Logement, which requires local knowledge to navigate effectively. But for investors who master the rules, Montreal delivers a rare risk-adjusted mix. Solid yields plus appreciation without Toronto-level costs. Number 3, Halifax. Halifax is the breakout market. The CMA surpassed the 500,000 mark recently as immigration and interprovincial migration surged, and one-bedroom asking rents have climbed above $2,000 in many active listings. Supply hasn't kept pace, so vacancy is tight and institutional competition remains lighter here than in Toronto or Vancouver. Neighborhoods like the North End and South End capture students, healthcare workers, and newcomers. That mix keeps demand broad and resilient. The risk is market scale. Halifax is smaller, so a large new project or a sudden policy shift can move vacancy materially. But long-term, Halifax looks like one of the best growth plus yield stories in Canada. Number 2, Kitchener, Cambridge, Waterloo. KW is one of Canada's fastest-growing CMAs, driven by tech expansion, universities, and GTA spillover. One-bedroom rents are around $1,800 plus in the current market, and the job ecosystem, anchored by major tech employers and research institutions, provides durable demand. Investors benefit from multiple tenant streams: students, tech workers, and commuters. Neighborhoods near the universities and transit corridors perform best. The primary downside is the Ontario policy environment. Rent guidelines and tribunal timelines still compress turnover strategies, and price acceleration can compress yields quickly. Number 1. Calgary. This will surprise some of you, but the data supports it. Calgary recorded one of the highest year-over-year population increases among major CMAs through 2023 to 2024, as people sought more affordable jobs and housing. One-bedroom rents sit in the mid-$1,500 in recent snapshots, while home prices remain substantially below Toronto and Vancouver, producing realistic cap rates for many asset classes. Crucially, Alberta's landlord-friendly rules mean landlords have more room to reset pricing on turnover. The law requires 12 months between increases for the same tenant, but there's no fixed annual percentage cap. Combine that with strong in-migration and improving local job growth, and Calgary becomes the rare market where affordability, demand momentum, and legal clarity align. Neighborhoods such as Beltline, Bridgeland, and Mission show tenant demand and appreciation potential, while suburban multiplexes in areas like Seton and Evanston offer very strong cap rate plays. So what does this list tell you? It tells you Canada is fragmented. If you want cash flow, lean toward Calgary, Edmonton, or Winnipeg. If you want appreciation, Kitchener, Waterloo, Montreal, or Halifax have the best thesis. Toronto and Vancouver still reward scale and patience, but they demand capital, tolerance for low initial yields, and readiness for political risk. That's the countdown. Use the data, not the hype. And remember, in 2026, investing well means understanding a city on its own terms, not treating Canada like one single market.